In days gone by, many private companies had pensions that could guarantee an income for their employees in retirement. But those days are gone, and so are most pensions.
The financial side of retirement is extremely uncertain, but many mainstream retirement plans are mediocre at best. Though the desire to retire persists, the financial challenges of retirement have increased.
We're going to talk about retirement plans and how you prepare financially for retirement and the financial tools that you can use to build wealth.
Many pensions of the olden days, they were around a guaranteed income for people, but why aren't they around anymore?
Well, the guarantees were based on the solvency of the company and their ability to fund those. And it was kind of a marriage between the government overseeing it and the companies doing it. And the regulations were not tight enough, and companies spent the pension plans or underfunded them.
Sometimes you had the unions that stepped in then as well to try and take over for the companies, but then the same thing happened at the union level. They spent the money and didn't fund those pensions enough. And so people that were expecting a guaranteed income when they retired, sometimes didn't have what they thought they were going to have.
I remember George, he was a patient of mine when I was still a chiropractor, and he was retired from General Motors. And the government and General Motors got together and they cut pensions, and it cut his health care completely out. His wife died because she could not get the health care she needed because her care plan that was guaranteed in that pension fund didn't pan through.
Well, today, a lot of the pension plans that still remain are either with very big companies or with state governments. And a lot of the state governments that have pension programs, their programs are underfunded.
In fact, there's only a handful of states that have fully funded their pension plans.
So what does that really mean for people that are going to be retiring? Could they lose those benefits?
Yes, absolutely. So we have a client right now. He's retired, but he realized my PERS coming from the state I worked in, I don't know that that's going to continue. And so he has made plans himself. He is saving and making his own plan. So if that falls through, he still has something. And if it doesn't fall through, well, then he has something more. So he's got options.
That's a really wise course of action.
And it's a good course of action because a few years ago, we had a client who was retired, again, was receiving PERS. And he gets a letter in the mail probably 8-9 years after his retirement. And they said, oh, we miscalculated. And what you received in the past was incorrect. We're going to lower that. Plus, now you have to pay back what we paid you over the course of 8 to 9 years. That's horrible.
That's terrible. That could only come from government, because otherwise the government would step in and change the rules. But since it is a government pension, who's going to enforce the rules?
Yeah, he's stuck with it.
And we're talking about PERS. That stands for Public Employee Retirement Savings. But actually, it's an investment that the state does on behalf of their employees. And if those are overprojected, like many funds are, saying they can make 12, 13, 14%, then they're naturally underfunded. Or maybe they've been pilfered by the state because of poor regulation. And, just like Social Security funds are now an IOU, they're not really a fund someplace that's waiting for you to draw back out that you paid in. So it's very important that we make sure that we prepare, not depending on government, not depending on some company that has not proven itself financially fit to be able to take care of their employees once they retire.
These problems with pension plans prompted the rise of defined contribution plans. And we can really break down retirement plans into a couple different types. There's defined benefit plans, which are like the pensions of old, and there's different flavors of those. And then you have defined contribution plans, and there's many different flavors of those. Defined contribution plans are often company-sponsored plans, like 401ks, 403bs, 457s, even a SEP IRAs for self-employed.
All these plans are government sanctioned. Government came out and said, oh, you can do this, you can do this, you can do this.
They allow you to defer the taxes on these plans. So they are defined in the tax code. In fact, 401k refers to section 401k
of the
IRS code, and same with 403b, 457. But all of these plans allow you to put money away. It allows the company to put money away. Sometimes they allow for employee contributions as well, but you don't have to pay the taxes on it now. So that's the draw for these plans. Then you get all this tax deferred growth based on whatever the plan is invested in. And then when you take the money out is when you pay the taxes. And so the idea is that everybody's going to be in a lower tax bracket when they take the money out in retirement than when they put it in during the working years.
And of course, what drove these plans is that the companies that sponsor these plans for their employees get a big tax break because all their contributions they don't pay taxes on. The employee, once they retire and starts taking the required minimal distributions from that, are going to pay the taxes the corporation should have paid back when the money was first deposited into those accounts.
Yeah, it's a tax break for the company on the front end. And then the company can't pilfer as easily or not underfund because they've defined the contribution, not the benefit.
Before these plans came in 1973, I think the first one came in, the savings rate in America was 14.7% of what people were making.
So you're talking about people themselves
People
were saving
themselves.
like 14%
Yes.
of what they made. That's a large chunk. What is it today?
These plans were supposed to help people start saving, but today the savings rate is 3.8% as we record this podcast. And there has been times between 1973 and today that the savings rate has actually been negative. So
Well-
did they work?
So a lot of people are thinking these government plans is their savings. Are they saving anywhere near that 14%? No.
No.
And even if they can call that savings, which
Yeah.
they really
And,
can.
and something about these plans too is because it's before tax dollars, you think you have more than you actually do. So on the positive side, people can look and actually have a number that they take responsibility for and work for planning their future around. On the downside, they have a number that is inflated because taxes haven't been taken out of it yet.
So when they start taking the distributions from there, then they have to pay tax.
Then they have to pay taxes on it.
And the way
And
they're
so
sold
not all
is
that
that's
money is
an
theirs.
advantage because you're earning growth on money that hasn't been taxed. And so people think, well, I'm going to get ahead this way. But at the same time, they don't realize that all that accumulation is going to increase the tax liability in the future.
Yeah. So you just have to understand that not all that money is yours and plan accordingly if you have one of those plans.
So what about IRAs? That's not the ERISA things that were started back in 1973.
Right. They're not company sponsored plans. Those are individual accounts that people can start to put money away. And it allows them to defer taxes, just kind of like a company would defer taxes, or like the employee themselves could defer taxes by putting employee contributions into a 401k. It allows them to do that at the personal level without a company involved. So as long as they have an income, they can put a certain amount away, defer the taxes on it. That would be an IRA. If they do go ahead and pay the taxes on it, then that would be a Roth IRA because then they get the tax deferred growth and they don't have to pay taxes on it when they pull it out.
So IRAs were started for people that didn't have a company that was sponsoring a 401k plan for themselves so that they were, quote, equally treated according to the tax
Or for
code.
people who wanted to put a little extra away and defer the taxes on it. So all of these plans, they're tools. They have a place. If you need to shift income from before taxes to later in life when you're in a lower tax bracket potentially. But they can also be overused because inflation is going to hit these plans some of the hardest.
Well, the other thing is that these plans have not really produced what they were promised to do. I mean, 14% to 3% savings rate is not really a success rate. And so now what individual states are doing, and California was the first one on the bandwagon for this, is they're making 401k contributions mandatory. And they just mandate it that if you're employed, then they're going to take that out of your account at the state level and fund that 401k for you. Unless you opt out and know that that law is on the books, then that's going to reduce your lifestyle today, whether you can afford to pay that or not. So you need to understand the laws in your state so that you're not being taken advantage of.
So we're not even saying that these 401ks, IRAs, anything like that are bad, but are they best? Are they best for you? They do have some limitations.
Well, if you put $500 away every month for 30 years, You'll save $180,000. If you can earn 8% compound interest, say in a 401k or an IRA, then you could end up with $734,000.
Wait. I heard that you could earn 11 or 12% when I listened to the radio for that guy that likes to.
A lot of people like to put a label on it. You can earn 11%, you can earn 12%. But if you look at the financial planning software and what they're projecting right now based on historical returns in the current environment, they're only projecting about 8% for an aggressive asset allocation right now.
And the government now has made regulations that indexed universal policies can only use a 6% rate of return. Otherwise, it's over projecting, and they say that is misleading as a sales representation.
Interesting. If you can earn 8%, let's say you end up with $734,000. But if you take taxes out of that every year, taxes on the growth at 20%, you're only going to end up with $541,000. If you take a management fee of 1.5% a year.
And are there management fees associated with this, I'm assuming?
There are.
Okay, and 1.5% is?
1.5%. It could be an average management fee. It could be a little higher. It could be a little lower, depending on what type of investment.
Okay.
If you take that out every year, you're only going to end up with about $426,000. If inflation is 2.5% a year, that $426,000 is only going to feel like $204,000 of purchasing power.
So inflation right now, as we're speaking, is over 3%. So you're using very conservative numbers there.
When you realize you put $180,000 into this, and you only have $204,000 of purchasing power 30 years later,
Wow.
It's not a good deal.
Well, then I also think about what happened in 2008. That was 16 years ago, but we can't forget 2008, the market crashed, and what people had in their 401ks, they had been saving money, but all of a sudden it went way down. And, there was even joked, they became 201ks. And if they were someone getting ready to retire, they now had much less in their 401k.
Yeah, that volatility, if it comes in a year that's the wrong year, it can be huge and detrimental.
Or if it happens even after you've retired and you're trusting for the market returns to continue to generate the income that you're going to live on, and now you're dipping into the principal of what you've saved in your 401k or IRA to live on, that means from here on out, you're going to have a lower lifestyle because you're dipping into you're still in the goose that lays the golden egg. And if it's not a big enough principal there, you're not going to be able to live on it, and you're risking running out of money before you die.
I hope the first part of this discussion hasn't been too negative or dismal for you. When we get back from the break, we're going to talk about solutions. The financial side of retirement can be better than what many people are forecasting, but you have to do something different than most Americans.
Did you ever play with a set of these rings growing up? They make a great visual picture of how you should set up your finances. On top, you have the higher risk investments, the lower risk investments. This ring is debt, this ring is savings, and this ring is protection. This stand represents the economy. If there's one thing we know about the economy, is that it will change, and it does, and this can change. It's unstable. What some people do when they set up their finances, they take and they go for the shiny, high risk, potentially high yield investment. Now, potential return does not mean probable, and it is definitely not probable. So this doesn't perform as well as they hope, and they think they should add a more conservative investment that actually might return something. So they add that, and believe it or not, some people will go into debt for that. Add that to the debt they already have, and there's their debt ring right on top of that. If you are listening to this podcast, I hope that you have time to click the link in the description for the YouTube video, and we'll tell you where in that video you can see this demonstration, because it really comes alive when you see it. Well, you have these three negatives, these investments that aren't returning as well as you had hoped, and your debt, which is just a draw on your finances. And people think, I should probably save something. So they add savings to that. Then they look at what they have going there. It looks a little precarious. So they plop some protection right on top of that. Well, if there's one thing we know about the economy, is that it will change. It is uncertain and unstable. And as soon as it changes, you lose your protection and your savings, which are the two things you want to keep most. That's the importance of doing it right. Start with protection. That makes a nice foundation for everything else you do financially. Once you have protection in, then add your savings program so you can keep more of the money you make. Next, make sure your debt is handled. Pay off the bad debts, keep the good debts. A good debt is one that gives you a tax advantage or limits your opportunity costs and allows you to make money. Once that's handled, you can do an investment. Hopefully this is something you know about, because those type of investments that you know something about tend to return better. And if you have extra cash flow and want to go for one of those potential high risk, high reward investments, then you can do that too. Now, when the economy changes, you're much more secure. At McPhee Insurance, we specialize in helping people set up this layer, the protection layer, the foundation for what they do financially. We specialize in designing and selling whole life insurance that becomes this protection layer for you. It's a good foundation for everything else you do financially. If you need life insurance, or if you need to get a life insurance policy you already own reviewed, we can help you with both of those things. Contact us by phone at 702-660-7000, or you can email us, team@mcpheeinsurance.com.
No matter what you do financially, I believe there is room for improvements if you keep your options open. I strongly discourage people from making binding permanent agreements that limit your options in the future.
Mainstream financial planning says that you should max out your tax qualified plans so that they have a long time to compound for you. But as we just saw before the break, that doesn't always compound the way you think it will. And so is that really good advice today? You have to question that.
Putting all your eggs in one basket, some can be a risk that you're taking if it doesn't turn out the way you want. And that's a very good example of putting yourself in a position where it cuts off options in the future. For example, if you've funded your 401k completely and you have an option to make a very good investment and get a high return on it, it's going to be very hard to get the money out of your 401k to do that. And so options and opportunities could pass you by, whereas if you had even part of that nest egg in a different fund that had more liquidity, you could have ended up being wealthier because of that.
I think a principle in life goes along with what you're saying, that the more options we have, the more we can go through life, make our decisions accordingly, because life is not static. You can't just make a decision, set it, forget it, because there are things that come along and may change the way you need to go. And just think about it. If you're driving down the road, you know your destination, you want to get there, you're driving along, but there's an accident in front of you. You can either sit there and wait through it, but if you think of another way to get there and you have the option of getting off the course you're going, you could get there much more quickly. That same principle of driving to where you need to go, you may have to change your course a bit, can also apply to financial planning. Something comes along in your course, you have a decision to make, and you can alter what you're planning if you have enough options on the table. But if you have put your money in one place and it's just stuck there, you can't get to it, well, then maybe you need to think about where else can I put my money to give me more options.
Mm-hmm.
Tax qualified plans definitely take options off the table because you can't get to that money. But if you have a place where you can get to the money, where it's growing steadily, that place helps you to combat inflation. It adds options on the table because now you can go ahead and finance a business. You can keep the savings long term if you want to put it toward retirement. It just gives you more options for working with that money. And one of the best places that we have found to keep that savings over a long period of time is participating whole life insurance. When it's designed well, it grows a guaranteed cash value that is guaranteed to increase every year. And we know it's going to equal the death benefit someday at maturity, age 100 or age 121. So we know it's growing every year. We don't have to wonder if it's going up and down in the stock market. We don't have to wonder if we won't be able to access it 20, 30 years down until we're 20, 30 years down the road like a tax qualified plan. We know we have access to that along the way. This is a product that puts financial options back on the table.
John, that's such a good point. I was just talking to a client the other day, and he was saying, well, how does life insurance improve what I'm doing with my self-directed IRA? Because I invest my self-directed IRA. And I just told him, well, when you borrow from your IRA, what kind of return are you earning in your IRA on the money you borrowed? And he goes, I got you. I'm not earning anything except what I'm investing on. I said, in the life insurance, you keep earning a compounding growth rate, even if you've borrowed against it. The other thing is that when you invest with your IRA, where do the funds of your investment have to go back? They have to go back in your IRA.
Yeah, and they can't invest in anything that benefits you.
That's correct. So having just that little conversation with him, he's a very good investor, but he didn't understand the value of whole life insurance. It would compound his earnings so much more because of the fact that he could have liquidity and he wouldn't be restrained about how he could use that money, and he would continue to earn that compounding growth rate even while he was using the money outside.
That is a huge benefit in life insurance. Another benefit that many people overlook when we're talking about life insurance in the context of a savings program is the death benefit, which is also an option on the table. And some people will say you won't need the death benefit when you retire, but this is another option on the table. Many people that get to that point still do want a death benefit. And if they don't, then that is something that can be repurposed or redirected into another channel.
It certainly can. It can actually be an estate planning tool that saves you taxes in the future if you've done it right. And many people say, well, you don't need life insurance when you get to retirement age. Well, if you've done as well as they say you could in investing, you're going to need something to defer taxes.
Another thing is if you truly do not need the death benefit, then you can take withdrawals from the life insurance and decrease that death benefit, or entirely roll a policy to create an income stream through something like an annuity. And of course, not all annuities are created equal. There are the guaranteed ones that you get a fixed certain income that can be nice financial tool. But there's also ones that could be more complicated, like indexed universal life insurance. Just like on the life insurance side, you have all these things that are tied to the market. You have the same thing on the annuity side. And there was a guy that I talked to recently. He had bought annuities right after 2008 because he preferred having the cap and the floor, that he couldn't lose money supposedly in the annuity when the market went down. But then he was wondering, why aren't these annuities growing like he thought they were going to do? And so he took a deep dive. He read the illustrations. He read the contract. He learned about cap rates and participation rates and spread rates. And he said, now I understand why they weren't growing the way I thought they were going to be. And after he wrapped his head around all of that, he said, I kind of want to forget about it all.
Annuities really come in all kinds of flavors, is what you're saying. And the annuities that we use are guaranteed annuities. They give you a guaranteed fixed income for the rest of your life. You can either defer that income stream, and that would be a deferred guaranteed income annuity, or you can start the income immediately, and that would be a single premium immediate annuity. And those are often really good for people that have invested heavily in a 401k or an IRA, and now they're in retirement, and they're concerned that when the market fluctuates, they're actually spending down their principal, and it's going to reduce their lifestyle. So we've helped people roll those monies into an annuity that gives them a guarantee that no matter how long they live, they cannot outlive their money.
That's another really good point. It does help extend money, avoid the stock market volatility. That's another area where the life insurance death benefit can help. Because even if you don't need the death benefit for a legacy at that point, but you're taking a 401k and rolling it into an annuity, you can get a little bit more income out of the annuity if you have a life insurance death benefit to cover the value of that annuity if you happen to die early and without receiving all the income.
Well, there's another kind of pension that we didn't talk about in the first half, and that is the 412(e)(3) plan. It's another IRS code example of how you can fund your own pension plan that's going to provide a guaranteed income for you. And this is primarily for business owners that don't have a lot of employees but have a high income, and they want to defer some of the taxes that they're having to pay on that high income. And unlike the 401ks or the IRAs, there is a very, very high limit on what you can contribute to these, like $340,000, but they're for very specific cases. And the government says you have to buy a fixed annuity that's guaranteeing you a return, or you can buy whole life insurance. It's only two things you can fund this with. And then the insurance companies, who have been very good at managing risk, not like the corporations of the past that squandered pension funds, they are the ones that guarantee that you'll get that income for the rest of your life.
This is a way to get some of the guarantees from those old pension plans without having the underfunding issues and all the regulation issues that go with it.
We believe that if you take responsibility for your financial future, you will be in much better shape than if you let the government or Wall Street do it for you.
You are the best person to manage the money that flows through your hands. Just get educated and know your options, make plans, and then follow those plans.
Next week, we talk about possibly the best financial advice in the world. It's from a book that has the reputation of creating more millionaires than any other book. The advice is simple, the results are significant. Listen in next week as we talk about this right here on Long Talk.